Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
Good morning, Huntsville and North Alabama. Hope you had a great week. You know, I've been thinking a lot, and when we look at how things are today, I mean, the markets are crazy. We've got 200 and 300 point swings. We've got uncertainty overseas. There's just a lot going on. But we still have a stock market that's really has gone pretty long-winded. I know some people say, well, you know, it's still undervalued, and some people say it's going to crash any day. The fact is, nobody knows. I mean, they just, nobody knows. So when you're looking at doing your own planning, you can be the eternal optimist and just think, well, the market's going to continue to go up. You can be the pessimist and think, oh, everything's going to crash tomorrow. But in reality, when history plays out, it's a little of both. And you got to be prepared for that. And it's all about the timing of your retirement. It really, truly is about the timing of your retirement. Think about this. Let's say that you were getting ready to retire and it's 1999 and market's been going crazy. You know, since 82, we had the longest peacetime expansion from 82 to 2000 in the history of the country, and you are looking pretty good. And so you decide to retire, and you decide to get much more conservative in your investments, and you're feeling pretty good because you're looking at income generating things, and you got your pension, you got your Social Security, you got retirement income from your investments in IRA. And then we think about, well, what happened if you would have retired in 2001? Well, there would have been a totally different attitude because we began the severe market correction in 2000 that lasted to 2003. And really the same story could have been repeated in 2007. You know, if you had retired in 2007 at the peak of the market, but if you had waited a year or so in 2008 or into early 2009, you would have seen a significant drop in your portfolio. And so you have to step back sometimes and say, okay, yeah, I need to have some money in equities. I need to have some money in the market. But what are other issues? What are other ideas? And how does this coincide with the new tax bill, tax planning, and all these complicated matters? Do I go back to the history books and just repeat what's been done over and over again? But you know, we're in a new world today, folks. There's a lot changed. Things are moving a lot faster than they used to. Companies come and go quicker than they used to because technology changes. You look at 10 years ago, commercial real estate was still very strong, and it really, in my opinion, never has recovered from the crash in '08. When you look at some of the stalwarts in industries like McDonald's, you know, McDonald's is playing defensive now. That used to be a guarantee. If you got a McDonald's store, you were pretty much guaranteed to be a millionaire. And that's not the case anymore. There's all kinds of market pressures. So the question we have to ask ourselves is, can we solve new world problems with old world solutions? I mean, that's really what it boils down to. And so looking at things and what some people would consider thinking outside the box, that's real critical because you've got to think outside the box when you're planning for your retirement, because there's all kinds of contingencies you've got to take into account. And as I mentioned, the tax issue, there's been some major changes in the tax code that is really probably going to benefit more people than it'll hurt. And I've put together what I call my tax cheat sheet. And it's a one-page, double-sided, very good resource for everything from income brackets to Social Security and Medicare taxes. It's a way for you to do some quick, easy calculations on your own to figure out what your estimated tax could be in several different areas. You know, contribution limits, required minimum distribution formulas, things like that. It's easy to read. And I'd like to make that available to all callers. So we can send you a digital format or we can send you a hard copy. If you would just call our toll-free number, 844-343-6045. 6048. That's 844-343-6048. We will be happy to get you a copy of that tax cheat sheet out. No cost, no obligation. That's gratis from the Ask Brad Show. So give us a call, 844-343-6048, and get your tax cheat sheet.
Taxes, taxes, taxes. It's not about how much you make. It's about how much you keep, especially in retirement, especially with a new tax law. Going forward, what will this mean for you and your taxes? Brad Williams has created a tax cheat sheet. It's a 2-page reference guide on the new tax bill and how it may affect you. For your free tax cheat sheet, give Brad a call at 844-343-6048. That's 844-343-6048. Or visit AskBradShow.com. That's AskBradShow.com.
Let's get back to what I was talking about earlier with, solving old world problems. We're going to need new world solutions, not old world solutions. As we look at where our country's gone, and one of the reasons I think we need to be looking at new world solutions is our country's facing something that we've never really faced before. And that is a mountain of debt. I mean, just a mountain of debt. When you think about the fact that from George Washington all the way to the end of Bill Clinton's administration, our national debt had accumulated to somewhere around $5 trillion. Think about that. That's a lot of money, isn't it? $5 trillion. And then by the end of George Bush, it was at 10. And then at the end of the previous administration with President Obama, it had gone to 21. So think about that. $21 trillion. That's our national debt. And when you put that into perspective, the government's going to need a lot more revenue to pay that debt down. Yeah, growth will help, and maybe some of the new policies are going to bring us growth to help us grow out of it. And that's a good thing. But when we look at, we've had an unusually and artificially low debt, with all the quantitative easings that had gone on to stimulate the economy, they have really exploded the money supply. And when you think about the fact that, from what I've studied, 10-year treasuries average somewhere around 4.5% historically. And depending on which study you look at, they got up over 15 during the latter part of Jimmy Carter and the first couple of years of Ronald Reagan. But as Reagan's policies kicked in and that changed that and interest rates came down, it bottomed out, I think it was in 2012 at 1.41 for the 10-year treasury. Now think about that. Banks and insurance companies use that as a benchmark for what they price their products in. And that's why things like long-term care insurance have been impacted so negatively, is because the insurance companies couldn't make enough margin on what they're making on their money to sustain those. What the government's really done is they financed all this debt on an adjustable rate mortgage, people, because, you got all these mounds of short-term, medium-term debt, and it's got to be constantly rolled over. We're now seeing that come to fruition as interest rates rise. Now, the Federal Reserve's not going to be able to rise them tremendously fast, or they'll shut the economy down. So they're really kind of walking a razor's edge, so to speak, because they can't go too far one way or the other. So when we look at, that's why I bring back the issue of new world solutions, because we've got to look at what is going to happen. The government's going to have to raise income taxes. I mean, they're just going to have to. Even though we're getting this tax bill now, we don't know how long that's going to last, because they've got to pay down the debt. I mean, when you think about it, what our financial planning industry has done is when yields start coming down, they started, because they're always looking to come up with new products and new solutions. And so they kind of exchange having end of life balances for the safe money quote or income planning quote. And so that's basically where you use something to buy a lifetime income, and, there may not be any left when you die. And that is a solution. Don't get me wrong. I'm not putting that solution down, but really it doesn't guarantee anything for your family at the end of your life in most cases. So when we look at how the adjustments have been made to calculations that a lot of the industry groups use to furnish education for us as advisors, that's really changed. It used to be they had a 5%. You could build $1 million up, take a 5% withdrawal rate, and you're pretty much assured not to run out of money before you die. And then that got dropped to 4 after the financial crisis in 2008 because of the steep drops that had happened twice between 2000 and 2009. And they've come out with a report that was in 2013. It was called Low Bond Yields and Safe Portfolio Withdrawal Rates. And folks, what they said in that is that if you want to be reasonably assured not to run out of money before you die, and when I say that, I'm talking about it's not that you're going to have all your money left. It's not going to be gone. That your withdrawal rate, a safe withdrawal rate, is 2.8%. Now think about that, 2.8%. So put that in context of $1 million. That's $28,000 withdrawal rates from that account in a given year before taxes on $1 million. And that only gives you about a 90% chance of not running out of money before you die. Okay. That's kind of scary. And so surely there's got to be other solutions, because when you kick in some of the volatility and things like that, you've got to be calculating what kind of income you're going to need, especially required minimum distributions. And see, everything's changed. I mean, we went as an economy, it used to be, everybody had not everybody, but majority of people had a defined benefit plan, which is where, the company put aside a certain amount of money for you every year, and that based on years of service and high five or however they calculated your income while you were working, you got a set benefit amount for that period. Lifetime, you could get a spousal rate for a discount, things like that. So this is what I'm talking about with new world solutions, because we can't apply old world solutions to them. Today, younger workers are having to rely on 401k because not many pensions are available to workers anymore. And we're seeing those companies that do, they're rapidly dropping those things because the liability in low interest rate environment for a company to maintain that really puts a strain on their business. Look at the Rust Belt companies that had a lot of legacy costs with pensions, and that killed them. Now, there's a great book by Matt Zagula called Smart Retirement. And what I'm talking to you about today is the smart retirement. You got to change the way you're thinking and look at things in terms of strategic movement around retirement taxation. That's what I'm talking about, folks. Strategic movement around retirement taxation. And so it's another strategy, and I think this is a great book for that. I've got 5 copies of this available, just 5, for the first 5 callers at 844-343-6048. That's 844-343-6048. And those first 5 callers at 844-343-6048 will get this book. You just will get in touch with you when you leave your information, tell you how you can get a hold of it. I think it'll change the way you're thinking about a lot of things when we start talking about that.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working. Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com.
I think what's important is when we look at the New World issues. One of the New World issues is that we have now reached a point where some things have kicked in that were set up a long time ago. I mean, the three big important date for retirees today is January 1st, 2008. And that is when the first boomer became 62 and was eligible for early Social Security. So that's January 1st, 2008. Now, the next one would be January 1st, 2011. And I'm sure a lot of my astute listeners already figured that one out. Well, that's 3 years from 62. That must be Medicare. That's exactly right. Because at that point, if you weren't still working, Medicare became your primary health care provider. And where did that come from? Well, a lot of that burden is paid for by the government. Yes, you have paid taxes into that, but that's a huge burden from the government simply because that money wasn't set aside. No, they can talk about trust funds all they want. But once politicians figured out that they could take an IOU and put it in there and spend that money, what do you think they did? That's exactly what they did. So when you look at what that's going to mean, U.S. government debt to GDP, gross domestic product, is it at unsustainable levels? So what's the government going to do about that? And that's why I think that discussing a smart plan, strategic movement around retirement taxation is important and should be discussed, because the first fix is raise taxes. That's the easiest way. Go from 15 to 20%, from 20 to 25. That's the quick and easy way. It's not always politically popular, but it's happened. The second is a little less obvious. It's rollbacks. For example, when Congress first started taxing Social Security benefits, and before, when Franklin Roosevelt set it up, he said, if you give your money to this old age and survivor pension benefit, it'll never be taxed. Well, that changed. And then they raised taxes again on it. And so that's what I mean by a rollback. Another way of rollback is in Medicare, where they just tell physicians, and my physician listeners out there who have Medicare patients will know exactly what I'm talking about, where they just say, well, we're not going to pay that much this year for that particular procedure. We're going to pay less for that procedure. So there's ways the government gets it back. They've got to get it back. So those are some of the key things that need to be looked at. And I'd like to go back, because since I was just talking about taxes, is I had mentioned earlier in the show about our tax cheat sheet. And I would like to make that available to all of our listeners. It is a great two-sided, single-page, handy reference chart to determine tax rates and required minimums and IRA distribution. And there's just all kinds of great information on there. I've got professionals in the accounting field that love this. They love to get it from me every year. And I'm going to make that available, 844-343-6048. If you don't get in soon enough to get a book, everybody will get a tax cheat sheet. We'll give everybody that 2018 tax cheat sheet. I'm going to tell you something, folks. I've been giving those out to my clients for several years, and they love them. I can't tell you how many compliments I get. I love this thing. I can, I keep it with my important papers. And that way when I'm, looking at my planning for my taxes, because it's right now that's important for planning for taxes. It's not at the end of the year or 2 weeks before you file for taxes. It's during the year that you're earning the money before you get to the end of that year that you can start making changes to reduce your taxes and take advantage of things that is written in the tax code for you. So, again, I'd like to give out that tax cheat sheet to every caller at 844-343-6048. We can send it to you in digital copy and email. We can mail you one. Just whatever your preference is, you just let us know. Let me get back to the show here and let's talk about, I mentioned the important dates. Okay. And I mentioned January 1st, 2008. And that's when the first baby boomer turned 62 and was eligible for early Social Security. And the second was January 1st, 2011, when the first baby boomer hit Medicare age. Well, another big one was June 15th, 2016. Now, how many people out there? Let's take a second. Ask yourself, what significance is that? Well, a big one, I'm telling you, for baby boomers and for everybody from now on, because that was the year that the first boomer turned 70 and a half and started their required minimum distributions from their qualified retirement accounts. That's the point, ladies and gentlemen, where the IRS and the government has said, okay, well, you've gotten to save all this money tax deferred, and now we want our share. And how that works is there's a table that is an IRS life expectancy table. There's actually several. There's one for spouses who are much younger. There's one for inherited IRAs, but that's not the one I'm talking about today. I'm just talking about your standard life expectancy, single life expectancy table. And what happens is at age 70 and a half, there's a factor on there. You divide all your IRAs and it tells you out of all of them what you have to take. And what that really breaks down to is a withdrawal rate of 3.649, because the factor you're going to see in the table is 27.4, where they're telling you, well, we're projecting at age 70 and a half, you've got 27.4 years left to live. Okay. And we want all that money out by then. So, when you look at withdrawal rates, what that equates to is 3.649. Now, I'd like to bring your attention to something I mentioned earlier, and that is Morningstar had come out with that report in 2013 that a safe withdrawal rate from your RMD, from your IRA, was 2.8. Okay, well, if the IRS is telling you at 70 and a half, you got to take 3.649 at a minimum. There's a disconnect there, folks. And so that's where sequence of returns, that's where not being so totally exposed to a volatile market comes into play. And I've covered that on other shows, because average rates of return are great when you're accumulating. But it's all about the sequence of the returns when you're taking distributions. Because if you're taking distributions out of bad years, especially in the early years, if the market goes down and you're taking your distributions out of those, you're sacrificing later years. So, there was an article in Forbes magazine that a noted professor from the American College in 2016 wrote. He said, taking distributions from an investment portfolio amplifies portfolio volatility, making retirement income planning tricky. And that's a quote, folks. And that's what I'm talking about. It's, have you sat down and looked at a smart plan? Have you looked at tax preferred ways to get your money out? Have you looked at how to plan for that, for the future? And have you looked and examined sequence of returns and the impact they have on your portfolio? Because that's what you need to be thinking about. And again, I'd like to make that available one more time. I got 5 copies of Smart, and that's the Smart Retirement. And I will be giving those to the first 5 callers, 844-343-6048. 844-343-6048.
Taxes, taxes, taxes. It's not about how much you make. It's about how much you keep, especially in retirement, especially with a new tax law. Going forward, what will this mean for you and your taxes? Brad Williams has created a tax cheat sheet. It's a 2-page reference guide on the new tax bill and how it may affect you. For your free tax cheat sheet, give Brad a call at 844-343-6048. That's 844-343-6048. Or visit AskBradShow.com. That's AskBradShow.com. Thanks for listening to our show today. For baby boomers, here's something to think about. Will you have enough income during your retirement? Are you absolutely sure? Do you understand the difference between growth and income? How about bonds and bond funds? Are you 100% ready for RMDs? Do you have an estate plan? If you've said no to any of these, we can help. Right now, for the first 5 callers, we'll send you a free custom-designed animated video retirement kit to help you plan for the retirement you've worked so long and so hard for. These custom video kits are loaded with cutting-edge retirement technology, custom designed to your specific areas of need. There's nothing else like them. So call right now to receive your very own custom-designed animated video retirement kit. Call 844-343-6048. That's 844-343-6048. A message from Brad Williams Financial Services, LLC, right here in Huntsville.
Do you have a plan or just a portfolio? Is your asset allocation structured for when you start your required minimum distributions? Are you investing for income or investing for growth for your retirement years? Have you reviewed your income options from distributions to make sure they're the most tax efficient as possible? Have you taken a look at the optimal time to take Social Security? And do you have a written plan of why that's a good day? If you've not had these discussions with your financial advisor, maybe you just have a portfolio and not a plan. Call for a free consultation at 1-844-343-6048. That's 844-343-6048.
A message from Brad Williams Financial Services, LLC, right here in Huntsville.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC, are not associated entities.
The postman comes. He brings you a letter that's certified from the Internal Revenue Service. That's probably the biggest sinking feeling a lot of people get. And you open it up and find out you've got delinquent taxes. What happens next? That's probably the biggest fear people have, is when they see that letter that comes from the Internal Revenue Service, or as Archie Bunker used to say, the Infernal Revenue Service. You know, that brings fear in everybody's heart, because there's probably no agency of the United States government short of the military that has more power. So what do you do? What happens? Well, good morning, Huntsville and North Alabama. Well, first off, I want to straighten out something that's happened. I've gotten several calls from people where they've gotten calls from folks at the IRS saying that if they don't do something right away, they're going to swear out an arrest warrant. Well, folks, we're going to learn about a lot of that today with Vern. He's my guest. But just to be clear, the Internal Revenue Service does not call you. If they want to communicate with you, they do it by letter, typically certified if it's that critical. So I want to welcome my guest today, Vern Gohanna. Is that correct? And Vern is the founder and owner of Tax Corp, IRS taxation specialist here in Huntsville. And he's going to help us out today with some good information about what happens if you do have tax issues. So welcome, Vern. How you doing today?
I'm doing well. Thank you for having me on today.
The first thing let's talk about is, what are the services that you specialize in? Why don't you give us just a kind of a broad overview?
So basically, I worked for the Internal Revenue Service for just under 10 years. I was a revenue officer, and I was responsible for collecting past due taxes and tax returns here in North Alabama. Jackson, Etowah, DeKalb, Marshall counties were my regions up in the northeastern portion of the state. And so I left the IRS in 2012, and I decided I wanted to help people. I got tired of seizing bank accounts, seizing property, motorcycles, homes, cars, investment accounts from people. And so now what I do is I protect individuals and corporations from the IRS. One of the most difficult things you have to do is actually get through to a live person at the IRS. It is one of the most infuriating things to sit on the phone for an hour or two or write 4 or 5 letters and you can't get through to them. Well, because of my experience with the IRS, I know how to cut through all those things. I know how to get in touch with people immediately and put a stop to some of the negative things that can happen to you if you do owe the IRS.
And, it's not the kiss of death to owe the IRS, because from what I've learned speaking to you and on my own, that, yes, it is a maze to deal with them, but if you know where to turn and which way to go, it's a lot easier. I mean, you still owe the money, but you can do it in such a way that the stress is alleviated considerably and you're operating within their parameters, correct?
Absolutely. A large portion of the American taxpaying public, and that's both individuals and corporations, at some point they're going to owe. You're going to either have low withholdings from your employer and you might owe a few $1,000s, a few $100. Corporations may have a windfall and have a higher corporate tax. Now that rate is lower. So a lot of corporations are experiencing some excess cash that they need to do things with. But almost everyone at some point in their life is going to owe something to the IRS. And the biggest advice I can give someone, pick up the phone, answer the letter, call them, and work something out before it gets ugly.
Well, because if you take, and correct me if I'm wrong, I know I've helped some people with situations like when they inherited money from an IRA and they never took an RMD. And then all of a sudden they find out they're 3 years behind or 4 years behind and they owe the IRS money, from say their dad's IRA. Well, there's ways to get around that where the IRS will typically forgive you if you go through the process.
Yes.
And so it's all about process, isn't it?
Yes, there are processes for everything. The IRS, so they have laws and rules that they have to follow just like everyone else. And one of the biggest things that people don't understand is, well, I owe, and I like round numbers when explaining things, you owe $10,000 to the IRS. But you can't pay it. You have nowhere near $10,000. You can barely pay your mortgage or your rent every month. Well, if you explain to them your financial circumstances, there's a program which is called currently non-collectible. If you earn less than the minimum housing, it's called allowable living expense that's set by the Bureau of Labor and Statistics. If you earn less than that amount, they can't force you to make a payment. They go away for almost 2 years and they leave you alone. But they won't know that unless you communicate with them. Or in other circumstances where maybe you run up, say, from a corporation, $100,000 in back taxes, but now the corporation is not doing so well. You can do what's called an offer and compromise where you say to them, listen, let's work out a deal. I can't pay you $100,000, but I can pay you 20. And the IRS is going to look at your financial statements. They're going to review your financials, your bank statements and other things like that. And they're going to say, we'll take $20,000. You pay them the $20,000 either immediately or over a period of up to 24 months. And they forgive the entire balance. Wow. It all goes away, but you have to go through the process. There's nothing in the process that includes sticking your head in the sand and hoping that they go away, because they're not going to go away.
In fact, they're going to get meaner and meaner as time goes on.
They're going to get rougher and rougher. Yes, sir. Right.
We're going to go to our first break now, and then we're going to come back. We got some specific questions for Vern. Folks, our giveaway this week, considering that we're talking about the IRS, is I've put together a handy, what I call my tax cheat sheet. And it lists all the brackets, deduction amounts for retirement accounts, Medicare premiums, really just about every question that you could come up with dealing with an individual's taxes, just as a reference point where you can see where you stand. And if you'll give us a call at 844-343-6048, that's 844-343-6048. We will get that handy tax cheat sheet out to you, either digitally if you'd like that, or if you want to leave your address, we'll mail you a hard copy, no cost, no obligation. And again, that's 844-343-6048.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. You know, many people contribute to their IRAs, 401ks, and other qualified retirement plans for years without fully understanding the rules, the tax implications, and options that are available until it's too late. It's like driving down the road to retirement without a map, or nowadays a GPS. For your free commissioned report on IRAs, call 844-343-6048. That's 844-343-6048. Or visit us online at askbradshow.com. That's askbradshow.com. Call now for your free report. For your free commissioned report on proper tax planning, call 844-343-6048. That's 844-343-6048. Or visit us online at askbradshow.com. That's askbradshow.com. Call now for your free report.
All right, now back to our show. Today we're talking to Vern Gohanna. Vern is the owner of Tax Corp, and what his specialty is IRS taxation. So, Vern, let's get back into what we were talking about before the break, and that is processes. For example, if you owe the IRS, they send you the letter, and I know the answer to this, but tell our listeners, can they seize your investment accounts?
Yes, they can. So as a revenue officer, and this is my former job here in North Alabama as a collection specialist for the IRS, any account, any asset that you have, whether it's a hard asset like jewelry, a gun collection, stamps, or an investment account, if they know about it, they can seize it. And then if it's a hard asset, they'll try to sell it. They'll sell it off at an auction. But currency like investment accounts, 401ks, stocks, patents, trademarks, they can seize anything that has a value. They can seize it to satisfy your past due liability. Yes.
So it's not a matter of them just seizing it and holding it for collateral. They're going to seize it and sell it. Is that correct?
They're going to seize it and sell it. Now, if it's liquid, if it's something they can cash immediately, like if you have a 401k and they see that. So every year what happens is that banks, employers, investment corporations, they will submit income and wage documents to the Internal Revenue Service. They're called IRP documents, IRPs, and they'll be your 1099s from your 401k. So now the IRS knows that you've got the $10,000 IRA with, fill in the blank corporation.
Right.
And they know your basis in it. They know how long you've held it. They know whether it's a long-term or short-term investment. And if they see it and it meets certain requirements, meaning that they can see that you have ownership of it with your social security number or a tax identification number, and it is a significant amount that will offset a large portion of your liability, they'll take it. Now, it doesn't have to be if you owe $10,000 and this account has got $9,000 in it. If it has $90 in it, if the IRS wants to take it, they'll take it and then they'll apply it to your past due liability. If it's an illiquid asset, something they have to convert to cash, then they go through a little bit of a different process, but they'll seize it and then they will sell it at an auction. And usually it's less than what the face value of the item is because they're trying to sell it quickly.
Oh, yeah.
It's basically the 80% rule.
A fire sale.
It's a fire sale. They're going to knock off 20% of the value of it just so they can sell it quickly. So you won't get the full value of that asset towards your liability. You'll get something markedly less minus their fees for holding it, securing it, and then putting it up for sale.
Well, let's talk about something like the family residence.
Mm-hmm.
Maybe that's the main asset you have and there's still a mortgage on it. Maybe you only got, 50% equity in it. What happens in that case?
It depends on who's first in line, first in right. So when you purchased your home, the mortgage company placed a lien on it. So now they're first in line to any equity or proceeds from a sale for that item.
Okay.
But let's just say, for instance, you were renting a property or you were renting first and you ran up a tax liability.
All right.
And the IRS sets a federal tax lien out there for $10,000. And then you go and you buy a residence. Now, most times no one's going to give you a mortgage with an outstanding federal tax lien. But let's just say in some event, maybe the title person didn't see it or it was filed in a different county and they just missed it.
Right.
Now you've got this property. Now it's got a $10,000 tax lien on it and you have equity in it. Well, the IRS can seize the property, sell it for whatever they can get it for it, get their $10,000 first, and then whatever's left over, they'll give it to the mortgage company because they're second in line to the property. So it's first in line, first and right. Whoever perfects their lien first in the county where the asset is located, they have first rights to your assets.
Wow. Well, folks, I know there's some good information. Hope you're paying attention and taking notes if you got a tax liability. Now, let's talk about, oftentimes individuals have property that they jointly own with people. Let's say that me and my brother own a rental property and he ends up with IRS problems. How does that affect me?
Well, if it's a jointly held asset, the IRS can seize your portion of the interest in that asset. If it's 50-50, they can seize it. If it's free and clear means there are no other senior lien holders on that asset. So if it's a piece of rental property, it's been paid off for years, you're just recouping all that money, they can seize that asset, sell it for its fair market value, whatever they can get for it, retract from it the taxpayer, the person who owes whatever they owe, and then give the change back to your brother.
Wow. So, and he has no control over that, right?
He has no control. Now, there are things, there are steps that he can take to protect himself. He can buy out your equity and then pay the IRS that difference.
Okay. If it's free and clear, he can take a loan out, get a mortgage, just use that to pay off the lien.
Yes.
Okay.
Mm-hmm. Now, I know for most of your clients who have investments, this comes into play where you got say, for instance, a joint investment account with a spouse.
Okay.
It's the same principle. They can still seize it. And let's say it's the husband who has a tax debt. They can seize that whole asset, take the husband's portion, and then give the change to the spouse.
Wow.
Yeah.
And, nobody else has that kind of power, do they?
No one else has that kind of power.
Wow.
None at all.
And that goes with college funds. So you could have done a great job putting away in a college fund, but, let's say you did it jointly with a spouse and you divorced and they end up with an IRS problem. You still got the same problem, right?
You've still got the same problem. Now, there are some, like we said earlier, there are procedures for everything. So let's say, for instance, you have a husband and a wife. They get married and the husband's got a past due tax liability that she doesn't know about. And 5 years down the line, this jointly held investment account, the IRS comes and wants to collect and she doesn't know about it. Well, she can file what's called either an injured spouse or an innocent spouse claim, basically telling the IRS, say, listen, I had nothing to do with this liability. I didn't know about it. And now his liability is affecting me and my assets. I want my personal to be separated from him.
Okay.
And so on all these tax returns, they will separate the liability and then they can only go after the owing spouse's assets. They can't go after any jointly held at that point.
Okay.
It's
but
better
again,
to do
it's
that
procedures.
It's a procedure.
Following the procedures.
Yes, it's a procedure.
Okay. Well, it's kind of like you may be really smart, but, if you're flying to Los Angeles, you don't want to be the pilot.
No.
You don't know the procedures. You don't know the GPS. You don't know all that. So you need a professional to do that who knows the navigation.
Absolutely.
And so talk to me about, since I deal with a lot of seniors and, deal with transactions when one dies and, maybe the second spouse and transition to family. What steps do you take when a spouse passes away or if you're an executor of an estate when it deals with the IRS?
So, and primarily whether it's a surviving spouse or an executor, the very first thing you want to do is file a final tax return for the decedent. Whether it occurs in January or December of the year, you want to immediately go get all of their income documents and file a final return that lets the IRS know this person is now deceased and they no longer will have a tax liability. Now, if that same surviving spouse or executor of an estate, you need to contact the IRS and you need to determine if the decedent has any outstanding tax liabilities or unfiled returns.
Okay. Because
there's a provision in the tax code that states that an executor of an estate, they are responsible for finalizing that person's tax matters, filing past due tax returns and paying their past liability. If the executor fails to do that, and there are any proceeds from the estate that are distributed to others, the executor will now be held liable for any balances owed to the IRS.
Wow.
So you have a cousin or a best friend or a military buddy who's the executive of your estate, and the person passes and has $100,000 worth of cash and assets. You distribute it amongst everyone as per his will, and then the IRS shows up 3 years later and says, hey, he owed $16,000. What did you do with his estate proceeds? Well, we distributed it. Well, but you didn't file a final return and you didn't satisfy this past liability. This now $16,000 plus tax can be now assessed against you personally as the executive estate.
Wow, that's big. Well, folks, stay with us. We're going to be right back and finishing up with Vern and learning how to deal with the IRS if you got tax issues.
Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com. Taxes, taxes, taxes. It's not about how much you make. It's about how much you keep, especially in retirement, especially with a new tax law. Going forward, what will this mean for you and your taxes? Brad Williams has created a tax cheat sheet. It's a 2-page reference guide on the new tax bill and how it may affect you. For your free tax cheat sheet, give Brad a call at 844-343-6048. That's 844-343-6048. Or visit AskBradShow.com. That's AskBradShow.com.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working.
All right, now in our final segment here with Vern, and Vern, you've been great. You've been giving us some great information. Tell me, somebody gets a letter. What is the process they should use? And if that's call you, then tell us that.
Well, first, if you do have tax issues, you can definitely give us a call here at Tax Core. Our number is 256-429-9229. We're located right here in North Alabama. I do give free consultations. Again, my telephone number is 256-429-9229. We do free consultations. We do Sunday, also weekends and evening consultations if you need those. The very first thing you should do, there's 2 types of letters you'll get from the IRS. Those are regular through the mail. They're not certified. They're just a regular letter. Those
are just informing you.
They're just informing you owe some money, pay it at the end of the month. Then you'll get a second letter. Then you'll get a third letter. The letters you need to be aware of are those that come to you certified that you have to sign. Those letters always come with 2 things: a final deadline to take an action, and you also get due process, meaning you haven't filed a tax return for 2015, 16, and 17. We look at your income for those years. You made $100,000 each of those years. We're going to charge you the maximum amount at 29%. We're going to multiply that times 3 plus a 25% penalty for each year. You've now got 30 days to submit to us a tax return disputing this.
All right.
And then we'll leave you alone. Or you owe $16,000. You've got 30 days to pay it. After 30 days, if you don't pay it, we can now seize a bank account. When you get that first letter, you need to jump on top of it. Don't let it get to the certified point. But if you do get a certified letter, you have to take action immediately. When you get that little beige or whatever color that card it is in your mailbox, if you weren't home and it says Internal Revenue Service, do not ignore it. Go and sign for it. Because even if you ignore it, when it goes back to the IRS as undeliverable or refused, to them, it's the same thing as if you got it.
Okay.
They tried to tell you and you ignored it. So in 30 or 45 days, whatever they said they were going to do in that letter that you ignored, they're going to do. And now you are limited in your rights at this point to get things fixed, turning in a tax return without a whole bunch of fuss, getting into a payment plan without a collection officer now having to come out to your home or place of business and get it resolved.
Okay.
Jump on top of it when it happens. You give yourself so much more leeway to fix the problem when you're in front of it versus when somebody like me shows up at your house or place of business and says you owe $16,000. Can you write a check today, or am I going to go to the bank and lock up your bank account? You don't want that discussion. You want the discussion to be, how much can you pay today, Mr. Gohana? I can pay $100. Okay, we'll take $100 and we'll leave you alone. That's the best position to be in when you get these letters or correspondence in the mail.
All right, so we go back in history and the old quote about no taxation without representation. Mm-hmm. Well, guess what? You got representation now.
You've got representation. Give me a call at tax score 256-429-9229. We do free consultations. I know all the ins and outs. I can get things done a lot quicker than, say, some of the other people that you may hear advertising. I'm local, so you can actually sit down with me in my office, or I'll come to you versus, dialing an 800 number somewhere in Colorado, Texas, or California.
And, I've had clients who maybe had an extenuating circumstance, had one that his wife had Alzheimer's and was dying of cancer in combination with that. And he just didn't file because he was so preoccupied in final couple years of his wife's life. And he ended up getting some letters, and now he handled it. But you'd be surprised. It's not the derelicts that just get involved in this. It's well-intentioned, good citizens who just fall on tough times or tough circumstances. And that's why you need a representative.
Yes, sir. I'm glad you brought that up. So in that kind of circumstance, there are what's called extenuating circumstances that will allow us to remove any of these penalties that you may get. Some of these penalties are 25% before they even get into the interest. So if you have an extenuating circumstance, severe illness or death of a loved one, you were out of the country on military service, you were incarcerated, those things are extenuating circumstances. The hurricane that went through up on the East Coast, anytime you live in wherever there is a federally declared disaster area, the April tornadoes of 2012 that came through North Alabama.
Right.
If you're living in a county or a zip code that's been declared federal disaster area, you automatically get an extension and you automatically get a waiver of penalties and interest for that tax year if you request it.
Okay.
So you have to ask for it. So you got to stand up and raise your hand and say, listen, I was affected by the tornadoes. I lost my records. I was displaced from my home. My computer got zapped and all my information was on there. Almost all of your penalties can be relieved for that tax period, not just forever. So if you do have an extenuating circumstance and that you believe it was inhibiting your ability to file your returns or even make your tax payments online, get representation, get an expert to help you out with it.
All right. Well, we're closing up. I really didn't intend on going this long, but I just thought with Vern, you were just bringing up some good points. So I went longer than normal when I have an interview. I know everybody likes to hear about investments and planning and things like that. But, since I help people with their finances, paying taxes is part of your finances. And so you need to understand the ins and outs of that. And one last time, Vern, if you would tell my audience how to get a hold of you, if they have or they know a family member or a friend has any kind of IRS issues.
So my office is located at 4833 Sparkman Drive in Huntsville, right across the street from Woody Anderson Ford Service Bay. My telephone number is area code 256-429-9229. That's 256-429-9229. My website at www.taxcorpllc.com. That's TAXCORPLLC.com. Or you can check us out on YouTube. I've got dozens and dozens of informative videos that talk about almost anything you would experience.
Great.
You can watch those 2 or 3 minute videos, see if you have an issue that's there, and give us a call. We'd be glad to talk to you.
And folks, if for some reason you're driving and you didn't get any of that, you can email me at brad@askbradwilliams.com and, just say, hey, I'd like to know about your guest on talking about the IRS, and I'll be happy to send you the links to all those. And again, Vern, this has been a very informative show, and I hope this has been enlightening to a lot of people. So thank you for coming. I appreciate you being on.
Thank you so much for allowing me to share with your guests.
All right. Well, we're at the end of another show. I want to thank you all for listening. I hope this was informative and entertaining, and I look forward to visiting again with you next week. Have a great week.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. 343-6048.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.